Hey everyone, today we're going to start talking about our third unit, our last unit that we're going to work on for the quarter, and that is macroeconomics. This is part one, so this week, the end of this week at least, we are going to cover some of the economic indicators that basically tell us how healthy or how well off our economy is. And then next week we'll talk about how those indicators can help us decide some different policies that we can enact, we being the government or the Federal Reserve, to help keep the economy stable and doing well. Before we get too far ahead of ourselves though, let's first talk about macroeconomics and just recap a little bit. Remember, when we talk about macroeconomics, we're talking about the branch of economics that studies the overall economy. So it takes a look at the large-scale economics rather than the individual firm or the individual producer or consumer in the marketplace. Macroeconomics studies wide economic phenomena such as inflation, so that's relating back to price levels, the rate of economic growth, national income, gross domestic product, and changes in the employment level. So to boil it down, when we're studying macroeconomics, we're really taking a look at the measure of how well an economy is performing so that we can better understand some of the forces that drive it and how we can project performance in the future and potentially improve upon it. So like I said before, we're going to take a look this week at economic indicators, and those indicators are what helps us determine how well off an economy is. It's this piece of economic data, usually done on a macroeconomic scale, that helps an analyst or an economist interpret current or future investment possibilities, and then it also helps them judge the overall health or wealth of an economy. So there are several different economic indicators that can be used, but three of the most commonly used by a majority of countries are things like GDP, or gross domestic product, unemployment, taking a look at the labor market, and inflation, which takes a look at the consumer price index, basically just taking a look at how do prices change over time. We're going to start by talking about gross domestic product, and then the second part of this video we're going to take a look at how that gross domestic product helps us understand the business cycle. So GDP, or gross domestic product, is really the measurement of all of the goods and services a country produces on its soil in a given period of time. Usually that period of time is quarterly, so 4 times a year, and then we'll take that combination and figure out how much is made yearly. GDP is monetary, meaning that it's measured in dollar or price, not in quantity. So we're not taking a look at how many items we're producing, we're looking at how much money is being produced out in the economy. When we look at GDP, there are two different ways to go about calculating it. We take a look at the expenditure approach and the income approach. The expenditure approach is comprised of these 4 elements here: consumer spending, investment spending, government spending, and net exports. It's the most commonly used method to calculate GDP, but the income approach also works and can determine what the GDP is for the given period of time. Keep in mind that when we talk about GDP, we're not just taking a look at the tangible goods, so not necessarily things that you can hold that are being produced, but it also considers the intangible services as well. So things like haircuts, lawn mowing services, anything like that also gets factored into GDP. To further boil it down, when we talk about final products refers to the final good or service that is being sold to the final user, rather than a firm that is going to use something to make something else. So we're looking at consumer goods rather than capital goods when we talk about final products. An intermediate product is a product that becomes part of a final good. That's a capital good that we've talked about in the past. Within a country's borders is pretty straightforward, and just like it sounds, it's domestic, or making sure that that product that we're measuring is being produced in that nation and not somewhere else being offshore. And then that given year or given period of time, products that are finished and ready for sale within that time frame that we're analyzing GDP, not just sold. So GDP calculates the items that are actually put on the shelf in that period of time, regardless of whether or not they're actually being sold to consumers. Now, GDP can be measured in a couple different ways: nominal GDP and real GDP. For right now, you really don't need to know the difference. We're going to relate more to real GDP, so that's the measure of total production in dollars after removing the distorting effects of price changes. Price changes can overall impact GDP, but again, right now, just need to know the basic concept of GDP. Like I said earlier, GDP can use 2 approaches. The expenditure approach is the one that we're going to focus on, and you don't have to know how to calculate it. You're not going to have a problem to you're going to work through it a little bit on a worksheet, but you're not going to have to know it for any type of assessment. So this approach is really important to understand because it gives you a look at where the majority of spending happens in an economy, and thus you get a better understanding of where economic simulation mostly is coming from. Okay. The expenditure approach to calculating GDP is essentially adding up all the spending that goes on in the economy. Though that spending gets broken up into 4 different categories. So consumer spending or consumption, which is spending done by the household; investment spending, which is spending done by businesses on things like physical capital, new homes; government spending, so the purchases made by any level of government on goods and services; and then exports, which also takes a look at the imports that we're bringing in to total and figure out how many imports we have as opposed to exports. So if we were to add that up, it would just be consumer spending plus gross investment spending, which is our investment spending that you see here, government purchases, and then exports minus imports. When you see the exports or the X part of the equation in real life, it typically comes in a negative number because they've already done, they being the Bureau of Labor Statistics has already gone about creating that data for you and calculating how many exports we've had after calculating our imports. So here's just a quick example if you wanted to work through it. You've got consumer spending here, plus investment, plus government, plus your exports minus your imports. Notice how the imports are larger than the exports, and that'll give us our total gross domestic product in billions of dollars for that period of time being 2011. Now, the second way to calculate GDP is the income approach, and the income approach is used basically by totaling how much money is coming in to those 4 major areas. So that's the consumer or wages, the money that they earn there, investment, so things like rent, because real estate is typically considered an investment, interest, which is typically coming from some government interactions and government purchases, and then profit, which is being made by the businesses in their exchange of goods and services, whether that's international or national. Again, you don't need to worry about this, but know that you can add wages, rent, interest, and profit and figure out GDP based on that data. Now, people will argue that GDP is a really great measure for economic health or wealth, but there are some downfalls that come with using GDP alone. It doesn't really calculate the lifestyle that a person has, so even though the GDP for a nation might be really high, the population as a whole might not have a quality lifestyle. Again, we've looked at different economic systems and their priorities, and their priority may be to have a high GDP, but the quality of life and social well-being may be subpar. GDP doesn't calculate the impact on the environment, right? Some of the production does have negative consequences on the environment. There's a video down at the bottom if you wanted to watch that talks about the hidden value in nature and some of the impacts that economic activity has on environmental factors like bees. Unpaid work is not calculated in GDP. It's purely based on financial transactions, so any stocks or bonds, things like that, don't get calculated. It doesn't include the sale of used goods, so thrift type goods, which can be trending, and you may actually be healthier or wealthier as an economy than you thought because you're not calculating those. And then it also doesn't include the black market or this underground economy that represents a variety of business activity that's being conducted without the knowledge of the government. So a lot missing here when we really think about GDP and using it as a major economic indicator. Now, the reason we talk about business cycle right after this is because the business cycle really relies on GDP for guidance. And basically what a business cycle is a representation of the ups and downs that an economy is going to go through over a period of time. If the GDP is larger and is growing compared to a previous quarter or the previous year, we can see that the economy is expanding and it's growing, it's getting bigger. But if the GDP is smaller or decreasing, we can see that the economy is shrinking and we know that the economy is getting smaller. That can also help us in understanding the health of the economy during given periods of time. So thus, the business cycle allows people to understand the direction of the economy, whether it's growing or shrinking, and helps us plan accordingly. It can help us determine when to buy a house or maybe when to quit our job and start a new career. You don't want to do those things when the economy is shrinking. You really want to try to only do those things when the economy is growing and there's opportunity for you to thrive. Business cycles essentially are just these alternating periods of rising and falling in real GDP, and an economy will follow a business cycle regularly. When we talk about the business cycle, there are 4 different phases that a business cycle will go through, and these happen over and over and over and over and over and over and over again and have been throughout history. We see various periods of expansion. Some are really long and some might be rather short. Eventually that expansion will peak, and then we see times of recession. And you guys have actually been part of watching an economy that was going through periods of expansion, eventually peaked out, and now because of some of the events that have gone on in society, such as COVID-19, we've seen this forced recession with major loss of jobs and things like that, common characteristics of a recession. And if it lasts for long enough, it may be considered a depression before it eventually bottoms out, becomes hits the bottom and becomes a trough, and then starts that cycle all over again. The next few slides are going to talk about the specific characteristics of each of the phases. The first one we're going to talk about is that expansionary phase. Typically, we tend to see income levels rise here. Firms are going to be more likely to hire more and more workers, which results in wages increasing, low unemployment, happy, optimistic people, which results in more spending, resulting in a demand for goods. Businesses then will start. Pretty easy to get a loan for those businesses, and businesses tend to make profit, and stock prices will increase. So this is when we see things are really good, people are happy, we're spending, businesses are opening, the economy is doing well. Eventually that's going to peak though, and the peak is essentially the highest level of real GDP for that given business cycle that we're taking a look at. At this point, the economy will stop growing, it's reached the top, GDP reaches its maximum, businesses will then no longer produce or hire any more people as they begin to tighten up, and hopefully, not to worry, but they do begin to prepare for some type of contraction because they know it's inevitable. That contraction is where we start to see income levels fall, more people start to become unemployed, businesses cut back on production, thus the number of jobs declines, people then become pessimistic and stop spending because A, they're afraid they're not going to have income to spend, and B, businesses have potentially cut back on the production of some of their products they were spending their money on. The banks will also tend to stop lending during this time to help tighten up the flow of money. Now, if that recession, that contractionary period, lasts for a short period of time, maybe months or like a few weeks into several months, we see that and we know that as a recession. This is when we see that real income decrease, the unemployment's increasing, and sales across the economy tend to dip as a whole. If a recession extends beyond a year, that's when we tend to see that time period of a depression occur. Now, hopefully the economy can overturn before that depression does occur, but if it does, it's only a matter of time before eventually it'll bottom out. This is when the GDP will be at its lowest, right? And from here, we know that the economy can go nowhere but up. At this point, though, the highest unemployment rate that we see will be here. Low spending will occur, and stock prices will really plummet. Now, there are a few different things that keep the business cycle going. 4 different factors that we talk about here. Business investments, low or high interest rates and credit, consumer expectations, and internal shocks. And I'll let you read through each of those on your own, but just know that these are really some factors that consumers are considering and paying attention to, in addition to some other things going on in the economy that keeps these ebbs and flows in the business cycle going time and time and time again. And the reason this is really most important to you is because there's going to come a time where you decide you're tired of working in one job, or maybe you want to start doing something else. It's important that you understand what's going on in the economy so you know when the best time to quit that job and start looking for a new one is. If the economy is going into a contraction, we know that jobs are going to become scarce, and if you quit your job, you may not find another. But if the economy is in a period of expansion and jobs are becoming readily available, it's a really good time to switch your careers and to start fresh. Another big thing to consider, you might want to make a big purchase. Maybe you want to buy a car or a house. You probably don't want to go buy that house if we're in a contractionary period because there's a chance you may not have steady income. However, if the economy is going on an expansion, you may feel more secure in your job, you may feel more secure in spending that's going on, and you might have a better shot of buying a house and being successful. Now again, this isn't the end-all be-all, but there's a lot to consider here as you go about considering things for your future.